This is a meeting organised by the Finance and Economic Statistics branch of the Royal Statistical Society. I'm Michael Baxter, the Vice Chairman of that section. And our speaker today is Matthew Swannell, who is the Chief Economic Advisor to the EY Item Club. He's had a long career as an economist, working for the ONS, the Treasury, the Bank of England, and BNP Paribas, and he is now the Associate Director at Oxford Economics. Over to you, Matt.
And thank you very much for having me here. I'm going to take you today through the EY Item Club summer forecast. Now, we first put that out a little bit before the summer break in July, how it compares to the OBR's forecast, which uses some similar underlying infrastructure, the Treasury model, and then sort of talk through where some of the forecast differences are, and in particular, why they matter right at the very moment. I should say before we start that I'm very happy to take questions as we go. There is enough material here for about a 30-minute presentation, so the 30 to 40-minute presentation, so there's also plenty of time for questions at the end as well. Where are we at the moment? I think that's the most important thing to start with when you're putting a forecast together. What do the data tell us about what's happening under our feet? That's something that not necessarily a model can tell you, but something that you yourself have to look at across the whole spectrum. And if we look back to the summer, and in particular as well, where we are now, what we've seen is that momentum in the UK has started to fade. Now, it's no surprise, I'm sure, to anybody that GDP was strong at the start of the year. We saw a 0.7% increase. That's dropped away to 0.3% now. And that's where our sort of starting point is for producing our forecast. Now, this chart here is my favourite chart to show the forecast in a nutshell. What does it show us? Well, the forecast begins with 2025. And you can see here that what we are expecting is modest growth. If we look back compared to history, the period before the financial crisis, we saw growth of almost 3%. Now, we've not been close to that for a long time. Growth over the 10 years before the pandemic was more like 1 to 1.5%, and it averaged about 1.2, 1.1 over that period. Over the last few years, they've been on a similar trajectory to that, or a little bit weaker. In fact, growing just over 1% last year. And we expect that to continue. You can see that here in the black dots in 2025 and 2026. We expect growth of 1% in 2025 and 0.9% in 2026. And you can see, looking at the bars, why that's the case. You can see that we do expect a pickup in consumption, modest investment but improving, and a drag from net trade in the near term. Now I'm going to try and unpick why all of those are happening, and in particular why they're so important. I think another section of this forecast that will be particularly important for our session, though, is to the end of the forecast. You can see there 27, 28 and 2029. In that forecast, we have growth settling at 1.5%. And to sort of not jump too far ahead, why that number is so important is that's relatively close to the consensus forecast at the moment, but it is a little bit less optimistic on growth than the OBR is. So I think the first thing we can do when sort of looking at the numbers is then try to unpack what's going on in the background. And that takes me to my next slide. So as it happens, this is quite an opportune day to talk through these slides, particularly on the left-hand side, given the Bank of England's latest decision. And what we do think is going to happen here is that interest rates are going to fall. Now, the question is more when and by how much. If we look at what the Bank of England said today, they are still minded to reduce rates, but there's growing concern amongst the committee members that inflation is sticky, and in particular that inflation expectations are becoming embedded. And with that in mind, we do think that the Bank of England is currently more concerned that they will cut interest rates too quickly, causing inflation and inflation expectations to become de-anchored and inflation to get stuck above the 2% mark, rather than cutting too quickly and having to support the jobs market and the growth outlook. We've seen quite positive numbers and some suggestions that the labour market isn't quite weakening as quickly as we originally thought. And you can see that here on the left-hand side. So what we do expect is the Bank of England will cut interest rates back to around 3.5% during next year. And that roughly matches the nominal pace of growth in the economy. So we do expect that by the end of the forecast, interest rates and nominal growth will be broadly matched. We have 1.5% real growth, 2% inflation, and a bank rate that matches that. We also see government borrowing costs coming down, but coming down quite slowly. And that largely reflects the fact that we do think there is some premium in the government bond price at the moment, as there's sort of global uncertainty around fiscal outlooks. And we do think that that will continue as well. So you can see here there's a bit of a spread on the left-hand side chart between the government bond yield and bank rate. And we do expect that to persist throughout the rest of this year and into next, before it gradually stays around 4%. So a little bit above the long-run growth rate of the economy. But the net effect of that is that there is some support to the economy coming from interest rates, but is relatively gradual. And it's also acting against the previous hikes in bank rate. Now, the vast majority of the UK mortgage market is all on fixed rates, with many of those fixed rates on 5 years. So even with interest rates falling, many mortgagors who make up around 30 to 40% of those who do own the house through debt, mean that they will be facing higher interest rates even now than they were when they took out a mortgage, particularly if that was in the race for space during the pandemic and when interest rates were very low in 2021. That means that the average rate on all mortgages is still rising, and we continue to think it will rise into 2027. So monetary policy is loosening, but its effects are ameliorated to some extent by the fact that many people are refinancing to higher rates. On the other side of the coin, we have fiscal policy and what's going on there. Now, it's no surprise here that we are seeing what is relatively flat spending, with a lot of that coming through the investment side of the equation, while the government continues to raise in taxes and government receipts. And the sort of levelling off in spending and the raising of receipts means that over time, the government is tightening the purse strings and continuing to hold back the stimulus that it's putting in through fiscal policy. In the grand scheme of things, this is higher spending and higher taxes than maybe in the spending plans that we saw 2 or 3 years ago, but it is nonetheless still a fiscal tightening. Revenues are raising more quickly than spending. The combination of these two effects is that the domestic economy faces some quite tricky headwinds, and that's why we see these relatively subdued growth rates over 25 and 2026 of 1%, before they go back to more normal levels of 1.5% from 27 onwards. Now, again, perhaps another opportune time to discuss this, but another change is the UK's changing arrangement and the impact of changing tariffs. On the left-hand side here, you can see the effective tariff rate applied on the goods that the UK exports to the US. So for the last 15 years or so, that effective tariff rate has been around 2%. The announcements by the US administration saw that tariff rate jump to around 12.5%. Now, there has been some progress made and some adjustments to those tariff schedules, but nonetheless, they still represent a big jump compared to the rates we were at previously. And that's what you can see here on the left-hand side. Now, what does the change in tariffs mean for the UK? Well, I think it's important to think of it through 3 channels. The first is that the UK's largest single export market for goods is the US. So we do think that exports will be reduced directly because of this. That's particularly impactful for certain sectors. On top of that, we also think that there will be a gradual slowing in the US economy. And a weaker US economy is important for all UK exports. The UK exports roughly twice as many services to the US, particularly professional services. So a weak export market in the US is also damaging to the UK via an indirect measure. And that's the second important thing to remember. And then the third is that the US is not only applying tariffs to the UK, but to the wider global economy. This also harms trade around the world and the growth rate of the global economy as well, which we do expect to slow into 2025 and 2026. Why is that important? Well, altogether, we do see export demand for the UK, both goods and services, slowing. And we do think that potentially they could be reduced by as much as around 1.5% to 2%. Some of that might be offset by reduced imports as the UK begins to change its trading patterns with other countries. But nonetheless, on the right-hand side here, you can see what we expect will happen to, or exports will contribute to growth. And we do think there'll be a drag in the near term. And that's what was also reflected on the first slide. So that is sort of the second big determinant of the growth outlook. And then the third near-term indicator relates to tariffs and the wider pricing environment, and that is inflation. Now, at the moment, inflation is 3.8%. Again, a good time to do this talk as the data is out just yesterday. And we think that that is nearly at the peak. We think that the inflation data for September, which will be released next month, will show a 4% year-on-year change. Now, we do expect inflation to come back down very gradually from there, but we do expect it to remain higher than earnings. So on top of all of this, we do think that earnings, and real earnings in particular, will slow. That will limit household spending power and will rely on saving less of their take-home pay every month, putting a little bit less of their paychecks in the bank every month to support their spending going forward. And all of that combined is why we think there's going to be a soft growth environment over this year and into next. And where we think that shows up in GDP, well, as I've mentioned, we do think that the weak real earnings impact has an impact on consumption. We think that the uncertainty and the global trading environment will hamper private investment. We think that the interest rate and fiscal side of things will generally weigh on demand. And as we've talked about, the tariff changes also have scope to weigh on the UK's export contribution to growth. But it's not just the near term that's important, it's also the long run. And this is what I've tried to show you here. Now, this is our first comparison to the OBR forecast. And what you can see here is, in the purple line, the outturned data for GDP in real terms. The yellow is the current item club forecast. And the white line is the sequential OBR forecast. So what we can see here is that the OBR has been consistently a little bit too optimistic on the growth outlook. GDP has continually disappointed. Now, that was a sort of statement of truth before the pandemic, and it has been the case afterwards. The pandemic, it's been a little bit stronger in the near term and has been very strong in the medium term. And as you'll have seen in some of the media reporting recently, there have been some suggestions that the OBR may revisit this at the upcoming budget. And that is sort of one of the key determinants of the fiscal outlook, and we'll go on to look at a little bit at that and how it impacts on the fiscal position a little bit later on. So the productivity growth forecast that we have is below the OBRs. I think to sort of understand where productivity is going, it's really important to understand where productivity has come from. And that's what I try to show here on the left-hand side. Now, we can see in the output per worker space that typically before the financial crisis, productivity was around 1.5% to 2%. Now, since the financial crisis, the UK has been suffering the productivity puzzle. Productivity growth has been much weaker, between 0 and 1%, and it has never caught up the lost productivity during the financial crisis. Now, it's called the productivity puzzle because the profession doesn't have a good answer for it. But what it is informative in telling you is where productivity might go. And that's what you can see here on the right-hand side. The productivity forecast of both the Item Club and the OBR is ultimately, in the words of David Miles from the OBR, an educated guess. And how strong your productivity forecast is depends how much weight you put on the recent history versus the whole sweep of history. The OBR puts a little bit more weight on the whole historical period. We put a little bit more weight on the near term. And consequently, as the right-hand side chart shows, that's why we have a lower productivity forecast and one that's closer to the near-term average as opposed to that longer-term average. The sort of argument for why you might go back to the longer-run average is that it's very difficult to predict when innovation might happen. If that's the case, then you should expect there's a good chance that you might either overperform or underperform any long-run average. And therefore, with this uncertainty around you, the fairest thing to do is go back to some middle ground. On the flip side of things, and the approach that we take is that the near term is more informative than those periods further away. There's big differences now compared to the period before the financial crisis, for example. In some of the statistics before the financial crisis, a highly leveraged banking sector contributed to productivity growth. With lower leverage limits, we no longer see such productivity growth. So we think those types of things should be factored in here. There's also some uncertainty as to when innovations might show up in the data. And that's also something that we have to bear in mind. If you see the ICT revolution in the 90s, for example, that didn't immediately show up in the economic data. And so innovations that are going on today around AI or other technologies might not immediately boost productivity either. They may happen beyond the time horizon of these forecasts. And for that reason, we tend to err towards the lower side and sticking to the near history. The OBR take a little bit more of an optimistic outlook. Before we go on too much further, though, I think it's just important to talk about house building. Now, this might feel like a bit of an aside, but it's important because the OBR introduced a change in their productivity forecast to allow for much improved house building potential in the UK. Now, this house building potential comes from how local authorities are viewed to hold the land and allows for greater use and house building. And the theory behind this is that this boosts productivity because people can relocate more easily and they can find jobs that they are more appropriately skilled to do. And with better matching in the labour market, a person who finds a job more appropriate to their skills is more productive and therefore supportive of growth. Therefore, this housing pickup that the chart shows here, where you can see the grey line, which is the final March forecast, compared to the yellow line, which is the March forecast before any of the policies the government announced relating to planning were involved boosting the housing stock. And overall, this is estimated to add around 0.2 to 0.3 to the level of productivity. And if people are interested in this sort of mechanism, the OBR did put out a supplementary paper about a month ago on this topic, which is available on their website if you'd like to read into the specific judgment that they laid on top of their forecast. Now, why do we disagree that this might be an overly optimistic effect to build into your forecast? Well, we can sort of see from history that it is a very, very strong pickup. And we think that housing transactions will be much more normal. You can see that here on the left-hand side chart. Now, there's a big zigzag in that profile. That reflects a tax change, the change of VAT, and when the temporary thresholds ran out. So there was a big run-up of people trying to move ahead of the change in stamp duty in March before people pulled back in April. But gradually speaking, we expect a relatively normal amount of housing transactions. And that's for a few things. Firstly, the fallback in interest rates will be relatively slow. The second, that is, house prices and housing affordability remains relatively stretched. And so it's quite difficult for people to move house and buy new houses. And then the third is that on top of that, there is some uncertainty lingering over the economy, as we've seen from the tariffs and the global economic environment at the moment. And when there is more uncertainty, there is empirical evidence to suggest that there is a greater delay on significant transactions. So if we put all of that together, we think that there'll be sort of a relatively gradual improvement in the housing market, which means a stabilization in transactions at normal level, and also a relatively gradual pickup in house prices to the 3 to 4% range. You can see that in the grey line on the left-hand side chart, which would be house prices growing roughly or a little bit faster than pay growth, for a slight increase in the house price to pay ratio, but broadly speaking, quite a normal pace of pay growth for the current economic environment. And that sort of tackles the demand side of the housing market. But we also think there is reasons on the supply side as to why those house building targets look relatively optimistic as well. And you can see that here in the right-hand chart. You can see that the cost of house building, that's labour and construction materials, and house prices have moved relatively closely together. However, as the labour market tightened, as the construction industry experienced various skill shortages, and as people pulled back from the housing market during the pandemic, that gap has opened. And relatively speaking, housing has now become relatively expensive. Sorry, the cost of building a house has become relatively expensive. And that means that there is potentially less of a return to building, and that market might not exist. So taking all of that together, we do think that maybe the house building assumptions the OBR built into their forecast are a little bit on the optimistic side. They may not contribute that improvement of productivity that's baked into their central forecast. So with the demand side of the thing out of the way, we'll turn a little bit to inflation, and the sort of headline message there is inflation will remain sticky. You heard it from the Bank of England, you've heard it from the OBR, and it'll be probably no surprise that that's something that we'll focus on as well here. Now, the key determinant of where inflation will end up in the medium term is the labour market and the labour costs that generates. Now, one thing that we'll have all seen is that the labour market has loosened a little bit. We can see that in various different measures of economic statistics. I'm sure you're all aware that there's been ongoing problems with the labour force survey. Nonetheless, we have seen a rise in the unemployment rate now to 4.7%. At times it's been below 4%. So we've seen somewhere between a 0.5 point and a 1% rise in unemployment. Now, that is not sharp, and it's not alarming, and 4.7% is certainly not a troubling level of unemployment. It's not the amount that we saw in the financial crisis, but it is nonetheless an important metric to gauge the overall health of the labour market and the direction of travel. If we look at why that's happening, we can look at the chart on the left-hand side. And what we can see is that for now, the reason that the labour market is loosening is that firms are hiring fewer people or hiring less quickly than they were previously. That you can see with the flows into work falling back. And what we're not seeing is the yellow line rise. We're not seeing signs of large-scale redundancies. And if we look at that, one thing we have to try and determine is this because of general economic weakness, or is it because of a big change that the labour market faced, with firms having an increase in their employers' national insurance contributions in April? And one of the ways we can do that is on the right-hand side, and that's looking at where in the payroll are the biggest changes coming. Are they coming in the public sector, where they were relatively insulated from the change in NICs? Are they coming in the low pay parts of the private sector, where these effects might be most acutely felt from the NICs change? Or are they coming across the board? And what we can see here is that from the autumn of last year, when the change was announced, we saw the labour market begin to turn a little bit and payroll employment to gradually decline. Now we can see that in the low pay private sector first, the yellow bars here, which may anecdotally be consistent with a bigger NICs effect. But what we can tell and see is that more recently, that's also been felt in the private sector. And that will be more indicative of a general slowing in the labour market and the general weakness in the broader growth picture feeding through into the jobs market. Now, ultimately, what we think that means is that the unemployment rate will continue to rise over this year into next, but we don't see those 8 or 9% that we saw in the financial crisis. We do think it will be more like 5%. And to some extent, as the Monetary Policy Committee have indicated, we need to see slack building to reduce inflationary pressure. So this is part of that disinflationary process continuing. Now, what does all of that mean? Well, on the left-hand side, we can see what it means for pay and inflation. Now, we do expect pay to fall back over the course of the year. That comes through two main mechanisms. The first is that pay is probably puzzlingly strong at the moment, with it being unusual, making a unusually strong end to last year, boosting the average annual growth rate. And that effect is starting to fade. On top of that, the net effect there is, of course, that pay growth is gradually falling back, and it's slowly going to approach the rates that will be consistent with inflation settling at the 2% target. Now, we don't expect that adjustment to happen quickly. We think that it will largely fall back to those rates by around the middle of next year as the labour market continues to loosen. So we do think with productivity around 1%, that you have to see pay growth in around 3% to get inflation back to that 2% mark. Now, what does that mean for inflation? Well, in the near term, there's a few different things going on, and we can touch on those a little bit later. But an ultimate deciding factor will be where services inflation goes, and that's really heavily influenced by labour costs, not just wage growth. And those labour costs, as you can see here on the right-hand side chart, are really still quite high, even for much lower levels of pay growth. And that is a reflection of firms having to pay these increased national living wage costs and increased national insurance costs. And we do think that this, because they haven't seen much of a slowdown in the overall labour cost, even though pay growth is weaker, will mean that services inflation remains sticky into this year and then again into next. We do ultimately think that inflation will fall back to target, though. We don't see any de-anchoring of expectations, and we expect it to land around that point towards the end of next year. This is the sort of overall inflation picture. You can see here, over the last few years, those big purple bars, the services sector that has been influenced by the labour market, has been making a big push. But in more recent times, what we've seen is that the drag from energy prices has disappeared. That's because having shot up and then come down, that's beginning to normalise. We also can see here, importantly, those grey food bars are beginning to pick up. And that is something that is really important, not only to the Bank of England, but potentially to the inflation outlook and the pay outlook, is because households are particularly cognizant of these prices. They're ones that they are really aware of and really feel the change in. And so when you see rises in food prices and also household energy bills and the petrol price, there is some evidence to show that people bargain more aggressively for pay rises, and that can lead to continued stickiness and inflation. And on the right-hand side here, you can see what that profile for inflation looks like. You can see inflation, we think, will pick up to 4% in September, remain elevated around 3%, and going down to 2.5% and 2% in the latter half of next year. But ultimately, we do think inflation returns to target in 2027 and will remain there as the Bank of England closes the output gap and keeps interest rates at a relatively neutral setting. Now, how does that compare to the story from the OBR? You can see that the OBR tells a very similar story. You can see here that they have pay growth slowing for some of the factors that we also identify: weakening jobs market, falling inflation, and some of the rise in employer NICs being passed to the individual worker, not just prices. While at the same time, we see some stickiness in inflation. People continue to push hard for pay gains. The labour market is not loosening that quickly. And on top of that, we are seeing potentially some price rise in these more salient factors. Now, why is the inflation outlook so important when it comes to a fiscal stance? Well, it's not just a growth outlook that we've talked about, where we've seen the OBR are relatively optimistic on productivity, but really it's the nominal growth outlook that's important for revenues. So if you have a relatively optimistic real growth profile and a similar inflation projection, then your nominal growth profile will also be a bit stronger. And that's what's going to be really important for why this all matters. So, addressing that question, why does this matter? Well, this is probably widely known. The government has set itself two major fiscal rules. The first is that it will only borrow to invest. And the second is that the public sector net financial liabilities, the share as a ratio to GDP, will fall. And both of these targets will be met by 2029-30. Now, you can see here in this chart that the government has set itself or left itself very little margin for error. The bars show in pounds billion how much space there is against that rule, the white bars being the two budgets set under the current government. And you can see that on both occasions, the headroom against the primary fiscal rule has been around 10 billion. If we look at the broad sweep of time since the OBR investigated and assessed the potential to meet fiscal rules, you can see that that is really by quite a small margin for error. You can see here that the average across all these fiscal events is around 25 billion. So the fiscal headroom is about half the size. And what that means in terms of probability, which is shown in the yellow line, is that the OBR think on balance, this is only just met. So the OBR gave a chance of meeting the current fiscal rule of only borrowing to invest by 2029-30, a chance of around 54% of being met. You can see, for example, during the period of fiscal consolidation immediately at the financial crisis, the probabilities were closer to 75%. So it is really quite a wafer-thin margin for error that the government began its fiscal plans with. Now, if we look into the year to date, how are we doing so far? Well, you can see that the current budget deficit, that's how much the government is borrowing to fund day-to-day spending, is already running a little bit ahead of plan. And you can see that by July, it was running ahead of things by around 5 billion. We'll get another data point tomorrow morning where we can update that assessment. And we can see that there is some potentially challenges on the horizon as the OBR anticipates a relatively sharp slowing in the latter half of this fiscal year. That's the yellow line here, compared to previous fiscal years. So there is the possibility that if nothing were to change, the government would have a worse current budget at the end of this year than it expected when the OBR last produced its forecasts in March. So that is getting things off on a slightly worse footing to meet these fiscal targets than we thought about around 6 months ago. One thing I should just briefly note here is that if we look at the broader borrowing metric, then things are developing a lot more as expected by the OBR. And that's a reflection of investments so far across the fiscal year being lower than anticipated. So there's two offsetting forces at play there. So why do these really strong productivity assumptions that the OBR set out mean so much? The OBR's scenario analysis makes that really clear. You can see here that if you change your productivity forecast, you ultimately change your growth forecast, and you have very little bearing on inflation. So you have ultimately either stronger revenues commensurate with a stronger productivity projection, or you have less revenues commensurate with a weaker productivity projection. What sort of scale are we talking about? Well, these OBR assessments suggest that in their downside scenario, productivity could be around 3.2% weaker, and that could reduce revenues by around 50 billion. Now, that would be a really, really large change to productivity. If it were to move productivity growth to something like our forecast, which would be more consistent with productivity being 1.5% lower in 5 years' time, and scaling these OBR scenarios linearly, you might see something in the region of revenues being 20 to 25 billion lower. So this optimistic growth forecast and the potential for it to be lower has the potential to change the fiscal position quite a lot, particularly given the very, very small wiggle room that the government left itself in its spending plans. And this chart here, to finally sort of bring it all together, really tries to show that. You can see here on the left-hand side that the spring statement started with around 10 billion of spending, 10 billion of space against this primary fiscal rule of only borrowing to invest. Since then, the government has announced some changes. There's been a change to winter fuel allowance and a change to welfare reforms. These have increased spending. Now, these are going to already begin to use up between half and 3/4 of this relatively small margin for error. But another feature of the economy over the last 6 months has been that gilt yields have picked up sharply. Now, this chart here shows the analysis that we did before the previous forecast, but broadly speaking, yields will be having a similar drag on the economy reducing some of this headroom. So you can see, taken all together, even before we look at our growth forecast, this fiscal space that the government has left itself in order to meet its rules potentially has been used up. And then if the growth outlook to be potentially reduced, as has been trailed by some media outlets in the last few weeks, there is scope for even more fiscal space to be taken up and leave the government with a bigger fiscal hole to try and fill in either via tax revenues or through lower spending. And that's probably really the primary difference between our forecasts, is this productivity growth assumption and the effect it has on how much fiscal space is left over at the end of the day, and how that impacts on whether the government has to change taxes or change spending to make sure it stays on track to meet its fiscal rules. Now, I'm aware that I've spoken for just over 40 minutes, so I'll stop there and take any questions that you might have.
Right. Anybody want to ask any questions? Well, perhaps I can ask one myself then. While tariffs on British exports to America have gone through the roof, those for other countries are a lot higher, like India and China. Does this give us a competitive advantage?
For the UK, it's a bit more difficult to tell. What we see is that the UK exports primarily services, and they are less price sensitive necessarily and not affected by tariffs. So what we are seeing is that there is scope for other countries to import into the UK, particularly China, where they may not have done. That could have sort of a deflationary consequence. It's less clear that there is a competitive advantage for the UK because it now sees lower tariffs. I should also say that although the US is is the biggest market, it is still only 20% of goods or 19% of goods. So the UK has lots of other markets that won't necessarily be affected by these as well.
Right. Second call for questions.
You mentioned, thank you for that. You mentioned the labour shortage in construction, which commentators have been talking about for a long time now. Do you see any prospect of that being addressed, and have you allowed for that in any of your forecasts?
So I think any labour shortage, it takes a long time to sort of clear the pipes generally because skills have to be developed. What we do have in our forecast is a relatively well-functioning labour market, so we don't have big mismatches. We have relatively stable productivity growth and a relatively modest rise in unemployment. In terms of the construction sector, as its whole, it is relatively small, but we don't allow it to have that big productivity boost, or that productivity boost, I should say, that the OBR factor into their central projection.
Okay, thank you.
Any more questions? I don't want to keep everybody here unnecessarily if nobody's got any more questions. I'm surprised. It's been a fascinating talk, and I can think of lots of questions I could ask, but I don't want to dominate proceedings. So perhaps I can let everybody go early. Thank you very much indeed, Matt.
Very much for having me. It's been a pleasure.